Welcome to Multiple Perspectives. I'm David Lofgren.
And I'm Daniel Brereton.
You'll notice that both of us are in the studio today, or in our own separate studios today. Starting this episode, we're going to have a slight change in format, which is that Daniel and I will be hosting the show together.
That's right. We can catch up on, the interviews that we're doing and what's going on in the world and, hopefully make it a much richer format.
Yeah, I'm hoping that with you and I both behind the microphone, Daniel, that we'll be able to give our listeners sort of a sense of what's coming up and maybe unpack or set up some of the conversation we're about to have. Because as you know, sometimes this stuff can get pretty in the weeds.
Yeah. A good intro, a good repartee, a little back and forth. But speaking of, you hosted this most recent episode. Who were you speaking with?
Sure. So the guest today is John Casmon. John is the owner of Casmon Capital Group. He's also a podcast host. He hosts a show called Multifamily Insights. And he's got an interesting story, one that I think our listeners and certainly equity multiple investors will be able to connect with, because he started out in the corporate world. He decided after some sort of tumult in the companies that he was working for in the corporate world that he wanted to take control of his own financial future. And he started by investing sort of directly in real estate, which is something that we hear from our investors all the time, right?
Yeah, of course. I mean, it's a common path for a lot of investors. They want to have financial independence and try something different. But, I hear Casmon Capital, I hear Multifamily Insights podcast. Would that imply that he's a multifamily real estate investor?
Yeah, so it's interesting because John, I think, took a path that we see sometimes, which is that folks start off in what I think most people think of when they think of commercial real estate investing, which is actually just sort of direct real estate investing, becoming a landlord. He and his wife invested in a duplex and then a quadplex and then maybe an eightplex or something like that. And then at a certain point, he realized that he was running out of money every time he was buying a new building, that he just didn't have the ability to sort of invest over and over again in a sustainable way, because none of these direct investments were actually cash flowing enough for him to scale this empire. It's, so from there, he decides to get into what he refers to as, sort of CRE, commercial real estate. John said this thing to me during the conversation that I thought was fascinating. He said, with a duplex, you're just not bringing in enough money for this investment to feel like a business. So you can't run it like a business. It's only once you get to this level of sort of scalability that you can actually start thinking like a business person. And I think that really stuck with me, that, there's a moment once you realize that you can actually be sort of investing on a grander scale in a more sort of institutional manner, that you can start treating your investing world like a business rather than just like an individual investment by itself.
Yeah, and I think, that's one side of the coin, which is this is big enough. I'm in the big boys club. On the flip side of that, you've got, this is a full-time business and I'm a full-time landlord now. I'm a full-time developer, or whatever it is, full-time real estate manager. And then I'm sure there's all sorts of things that cascade with that. You're dealing with 4 or 8 or 16 times the toilets and the tenants. So it just gets more complex. I'm interested to hear how he worked through that problem, worked through that scale, aside from the capital side of it, working through just becoming a professional businessman in real estate, and what advice he might have to, or warning signs to watch out for people who might be wanting to get into real estate directly, or steering it more towards starting out smaller with something like equity multiple.
Yeah, it's funny. You talked about sort of, I think when we talk to investors, oftentimes we have this conversation about where commercial real estate fits in the context of your portfolio, right? That's a conversation that we have all the time. With John, we were talking about not just sort of where commercial real estate fits in your portfolio, but also where it can fit inside of your journey, your investing journey. And, he identified that people come at it from two directions. Sometimes, like him, you start with direct investing, you start as a landlord, and you realize that you're looking for something more passive, more scalable, and you end up in commercial, sort of syndications or crowdfunding or becoming an LP of some sort. But he also identified that some people actually come at it from the other side, which is even if they know that eventually they want to become a larger scale player, but they're stepping out of the corporate world, they're sort of stepping into this world of real estate for the first time, it can feel pretty daunting to try and do the due diligence or whatever is necessary to convince yourself that investing, like becoming a GP or investing in some project, is actually worthwhile. So they use investments like we offer on Equity Multiple as sort of a method of dipping their toe in and getting comfortable little by little with the terminology and the process and understanding markets and business models and asset classes and such. And I thought that was a really interesting way of just sort of setting up the potential for these sort of smaller dollar amount investments as a learning opportunity, as this opportunity to sort of like get in the door without having to take out a mortgage on a duplex or something.
Sure. Yeah. And it just goes back to 10, 20, 30 years ago, saving up a few tens of thousands or $100,000 might get you, a substantial size duplex or triplex or whatever it is. Now you save $100,000, you're lucky to get, your own apartment somewhere in a very, third tertiary market.
Right.
So it just takes a lot more to get started in real estate than it did. It's very capital intensive. So I'm hoping to hear more about his story and how he did it, but many paths to real estate, and taking that first step, we're trying to reduce it as much as possible. But maybe we get into John's story.
Yeah, let's jump in and hear the conversation that I had with John Casmon. John Casmon, welcome to Multiple Perspectives.
David, thank you for having me today.
You've helped hundreds of professionals enter the world of multifamily real estate investing as passive investors, or through a structure that we often refer to as limited partnership. I'm wondering if we can just start by talking about what sort of the biggest misconceptions are that you see amongst first-time LPs or folks who sort of want to get into this slightly larger scale real estate investing. How do you sort of help them understand what they're getting into as an LP?
Well, the biggest misnomer is that it's even possible, right? I mean, most people think to invest in real estate, you have to buy a house and then you can either have it as a rental or you can fix it up and flip it and sell it. And those are the two ways that most people know. I mean, if you're really sophisticated, maybe you know about wholesaling, or they think you're a real estate agent, right? So, but that's what people think of when you hear, "Hey, I'm a real estate investor." They think, "Oh, you're an agent," or you're a landlord, right? You got some rental properties, you're a flipper, maybe a wholesaler, and they're not thinking bigger to think that you can invest in larger commercial real estate projects like apartment buildings. So that's the first thing, right? Is just really understanding that this is possible, that everyday regular folks, just like you and I, can invest in apartment buildings. It's not just for those super wealthy families that have accumulated wealth over the last, decades. People like you and I can invest in this. So that's number one. Once they kind of wrap their head around that concept, it's understanding how it works. So in our world, and very similar to others, in the real estate syndication space, syndication is just a fancy way of saying, we're going to take two groups of people. One is going to be active. That's going to be the general partnership group. We're going to go out there and find deals. We're going to do all the work. Okay. We're going to do the legwork on due diligence, getting the deal under contract. We're going to analyze the deal and all those kind of things. And what we're going to do is we're going to bring that opportunity to LPs, limited partners, or passive investors. And they have the chance to review that deal and invest. As a limited partner, that is really your responsibility, is to make sure you understand the deal, make sure you understand the team, you understand where their potential risks are, your own risk tolerance, and then to fund that deal and make that investment. At that point, you're done. The general partnership team does all the hard work as far as the execution and overseeing the deal and making sure that that deal is going to return a profit to the investors. So just wrapping their head around that is hard. And I would say too, probably the self-reflection part, because some people think they want to invest in syndication deals, but they really want to be more active. They want to be more hands-on, and maybe you're not comfortable letting someone else run the show. Nothing wrong with that. But the more you can identify that up front, the easier it's going to be, because this is truly a passive investment. Like, I don't get to call the CEO of Apple, or I don't get to call Elon Musk and tell them what I think they should be doing over at Tesla or Apple, right? Like, that's not how it works.
Right.
So
Yeah.
You buy the stocks, you buy the shares, you make the investment. You trust that they know what they're doing. You do a lot of your research up front to make sure you understand the way they think, the way they look at the business, the team, their track record. I'm doing all that work before I make the investment. Once I make the investment, it's hands off and I'm just watching the show.
Right. So you touch on a couple things there that we hear all the time from investors. The sort of most recent point you made there is that, being a passive investor, sometimes people don't understand that that's even possible. And I think second, when you think of owning real estate or investing in commercial real estate, most people, as you said, think, okay, so I'll buy a rental unit, buy a single family home or a duplex or quad maybe. And, you start to think, okay, that makes sense to me. I do a little bit of work here and there. They call me whenever the whatever, washing machine is broken. And essentially I have control over my little sort of nest egg investment in this building, very tangible. It's one of the cool things about real estate. Like you can go and see the thing you invested in. But I think it's a stretch sometimes for people to get from that idea of being a landlord to what we really say is a passive, ideally is a passive investment as an LP. And I think one of the things that people tend to struggle with is the idea that they're losing some amount of control, right? That like they can't call the operator, they can't call the sponsor and say like, listen, I think we should, be advertising this deal differently or something. How do you help people understand sort of the pros and cons of getting into an LP position in a larger investment?
That's a great question. So it starts really about understanding that person's goals. Some people really do want to be hands-on. And one way I think of it is if there's someone who wants to leave their job to be a full-time real estate investor, typically that's because they want to be more hands-on. They really want to learn the business. They want to learn how to navigate these deals, what they need to be looking for, how to address certain issues when they pop up. And that person may want to just be more hands-on. So maybe they want to be a limited or passive investor starting out, but their end game is to be active, to leave their job and do this full time. So if that's the goal, then certain investment opportunities may be right for them, but they may want to have more of a voice, or they may want more hands-on, either coaching or more involvement, or not so much involvement, but that they want to learn, right? They're investing to learn. So that's one investor. There are other people who have realized, you know what, I don't really like being a landlord, but I like the checks that come at the end of the month. How can I get those checks without doing the work, right? Without someone bothering me and calling me and telling me the washing machine broke at 2 a.m. and I've got to stop what I'm doing, wake up and run out here and try to get this thing fixed, right? A lot of people love real estate because you've got the cash flow you can generate, you have the appreciation potential, you've got the depreciation for the tax benefits, you've got leverage, it's a long-term proven, strategy to create wealth. So people get that. You inherently understand real estate is a great vehicle to build wealth and generate that for you and your family. But very few of us, literally, even some of us who are doing this, like very few of us actually want to be a landlord. So if there's a path to invest to get the benefits without the headaches, that is very intriguing to people. So it's really understanding what they're looking for. What is it about real estate that attracts you? What does a perfect investment look like? What do you want this vehicle to do for you 3 to 5 years from now? So once you get some clarity there, that helps people. I think it's also really important for them to understand expectations up front. And that's on both sides. As an operator, I want to make sure they understand what my commitment is to them, my obligation is to them as far as being a general partner and leading a deal. That's going to be from a communication standpoint. It's going to be from an integrity and ethics standpoint and what they can expect. And then on the flip side of that, I want to know what their expectations are, because sometimes you'll identify that maybe they're not aligned. If this person thinks that they're going to call me every day and ask me, hey, what's the occupancy? And hey, did you get any showings for the vacant unit today? That is not what a passive investor does. On the flip side of that, I do have some responsibilities as far as communication and updates. So we do monthly updates to our investors. My phone is always available for those people who have invested with us, because if you've entrusted us with $50,000, $100,000, whatever the case may be, if you have a question that I haven't answered or something that came up maybe through one of the messages we sent out or one of the updates on a deal, I'm happy to answer that. That's part of our responsibility when it comes to the investor relations side, is to make sure you understand our rationale, our thinking. But to be clear, we're here to communicate, not necessarily be dictated by you. So we may disagree on some sort of strategy or tactic. I would love to hear your opinion, but at the end of the day, the lead operators are going to make the decisions. I think it's important to be informed by our investors, because you could certainly have a perspective for a reason. but that doesn't mean you dictate that decision. The same way if shareholders reach out to Apple and say, hey, I think we need to stop with all these iPhone updates, or I think we need to just drop one a year, I'm sure that they would listen. But on the same note, they're going to look at all the information they have available and make the best decision. Just, real time, we'll talk about Tesla, right? I mean, the Tesla stock dropped like 25% based on some of the tweeting and the posts. I'm sure those shareholders are like, hey, bro, cut it out. Be quiet. Stop with all this, right? Well, there was certainly an impact, but he didn't care. And he can make that decision. So that's why I think it's really important to understand the character, the integrity, the value system of the operators you're investing with, because you want to make sure they're doing everything they can to protect your investment and grow it.
Absolutely. I wonder if there are ways that you sort of help frame that relationship for the folks who are coming to you as potential LPs that allows you to help them understand, like, listen, you need to be confident in me as your GP, or if you're putting together a group of LPs and you're trying to source a GP, there's all of this work that I think, at least at the institutional level, investors are going to do, or institutions are going to do upfront. Like professional investors will do all of this due diligence, and some of that involves modeling, some of that involves some complex math, some of that involves seeking out comps and calling brokers and stuff. And I think, for folks who are, again, maybe their framework is one of, you go buy, a multifamily house a small multifamily house down the street, a duplex or something. They feel like they can talk to a real estate agent, they can go kick the tires, they can literally go crawl around in the basement or the attic if they want to, right? They have this ability to have a really tangible sort of, at least if it might be more intuitive than anything else, but they feel like they can go actually lay eyes on the thing and shake the house, so to speak, right? And see if it's a good asset. And they probably have some understanding of, let's say, the market. A lot of folks end up being landlords in the town where they live or in a spot down the road. So there is this very sort of I can do this almost by touch and feel, and I don't have to learn a bunch of new concepts, figure out how to do some sort of institutional style due diligence. How do you help investors get from that place that is the sort of more, let's say, intuitive or firsthand experience of investing into property, and help them get to a place where they start to think, okay, there are a few things I might need to understand. I might need to do a little bit of research. I might need to do some sort of due diligence to allow me to feel confident that, the business plan is a smart one, that the operator actually has a track record that reflects success in this type of business plan, in this market, with this asset class. What are the things that you sort of outline for potential LPs to say, here's the checklist, here's the things that you at least want to take a cursory glance at to make sure that you're not just, throwing your money down a black hole that has a pretty sign on it?
It's a great question. So a few years back, I wrote this, this long article that kind of detailed specific things I think investors should be looking for. What I've done since then is I've actually taken all that and I've shrunk it down to 7 questions. So a particular free guide is 7 questions you must ask before investing in apartments. If you want to check that out, you can go to my website, casmoncapital.com/7 questions.
Awesome. We'll definitely put a link to that in our show notes too, so people can just get there quickly.
At a high level, I think there's a couple things to consider, right? So to answer your question directly, when I'm talking to investors and helping them understand the deal, the risk tolerance, and all those kind of things, since you can't just drive, a lot of times you can't just drive down the street, look at it and, tour it and learn it for yourself. It's one, understanding all those things you've mentioned, right? And it really comes down to 3 buckets. The first bucket's going to be the team, okay? The second bucket is going to be the market. And then the third is going to be the deal itself. I think stories are so important here because I could throw numbers at you all day long, but you don't have the context to understand if that's a good number or a bad number, right? If I tell you, hey, this deal's a 16 IRR and this deal's a 19 IRR, for a lot of people, they're like, well, 19 is higher, so it must be better. And that may not necessarily be true in a lot of cases, right? And IRR is the internal rate of return. And it's just a metric that helps you understand what the return is going to be and also how quickly you're going to start to see some of that return. And it's hard to compare those things. And I see a lot of investors, they do that. They look at return metrics, and if one's a 8% cash on cash and one's a 10% cash on cash, they just defer to, oh, that 10% must be better. So let's step back. Let's forget the numbers right now. let's understand the team first and foremost. Who is operating the deal? What's their track record? What's their history? Do they know the market? Who's the property management company? Do they have experience doing what they're telling you they're going to do? That is the most important thing. We all love the upstart and we all started somewhere. But the truth of the matter is you want to partner with someone that has a vision, that has the experience and can actually execute. What happens sometimes is, someone partners up with their buddy and they're both brand new into this space and they don't know Adam from Eve. And now they're both fumbling through this deal, trying to figure it out together. And that is a recipe for disaster. So the team. Make sure you're investing with people who have the track record, the knowledge, the experience. They understand the market. They understand the nuances of that market, and they can find success. The second thing is just that, the market. So where is this investment at? What do you need to know about it? Is it a growing market? Is it a declining market? Are there businesses coming into that market? Is it easy to do business? Are there a lot of, evictions? Is it easy to evict tenants if they're not paying rent? You want to understand all of these things. And that's at the macro level. At the submarket, you understand those things too. Is this an area that is growing? Is this an area that is in the path of progress is what we call it, right? And that means that there are more companies, there are more people moving to the area. There's funding, there's investment. You want to be in that area because demand is going to increase. One of the simple things you want to know and what we're banking on as investors is that we're going to be able to drive rents on our investments, right? Whether it's multifamily, commercial properties, retail centers, whatever it is. A lot of our investment thesis is that we're going to make more money in the future, right? We're going to drive rents up on these properties. Well, the only way to drive up rents is if there's more demand, okay? And you have to look at different factors to help us project how much demand there's going to be in the future. So I'm looking at those things. And then the last thing is going to be the deal itself. What's the story with the property? Why is it for sale at this time? Why is the current owner looking to sell? What's the opportunity for us? How do we increase the rent or increase value? How are we going to operate it? What's our time frame? Where do we think we can push rents? What validation do we have on our business plan? Are there comps out there that demonstrate we should be able to get rents? What kind of renovations do we need? What budget do we need? This is all really important. And you have to take all three of those things. And if I could take a quick step back, David, it took me a while to understand that because I was like the person you're describing. My wife and I, we wanted to get into real estate. I worked at General Motors. So I was working in corporate America doing marketing and advertising for 15 years. And when I was at GM, I was there and went through bankruptcy. And I had a hard time trying to figure out, well, how do I have more control over my future? And after doing a lot of research, real estate was the thing that popped up. I said, you know what? I need to start investing in real estate. My wife and I ended up moving to Chicago. We bought a 2-unit building. We then invested in a 3-unit building. And then I'm like, all right, this is working. How do we keep growing? I'm like, we got to go commercial. So we save up money. We buy an 8-unit building. The lender tells us we have to hire a third-party property management company. So I do that. And I'm starting to realize, I keep running into this bottleneck because I can only save up so much money, right? I'm starting to grow my family as well. And I'm just running out of money every time I buy a property. The second company I'm working for at that time ends up going through bankruptcy as well. So now I'm sitting in a situation where, man, I started off on this path to have more control over my financial future, just in case this company went bankrupt. I actually faced that a second time. And I'm like, okay, I've got equity in these properties, but I still don't have the cash flow I need. I have to find a better way to invest. I ended up meeting the guy who became my mentor, and that opened me up to OPM, other people's money, or this world of syndication. And I faced a lot of the challenges you just described because I was used to tangibly being able to see the properties, right? I only invested within a 30-minute radius of where I lived, and I avoided the south side of Chicago because trying to get through downtown was just too challenging, right? I never knew what traffic was going to be. So I stayed in kind of the radius
You're
where I knew.
You're basing your investments on traffic is what you're saying, so that you can get to the building fast.
Traffic and understand the path of progress. And in Chicago, there were two things I was paying attention to. One was the major highways, so Route 90 and 94, and then the other was the train system. So I was following the brown line, I was following the blue line, and I was trying to make sure that wherever we invested, we're close to the infrastructure there. So fast forward, once I started to get into the syndication space, learning through my mentor and starting to raise capital and work with other people, I had an aha moment. And the aha moment was that I was treating commercial real estate like the 2 units and the 3 units that I was investing in. And that's not the case. Commercial real estate is a business. And once that clicked for me, I was able to tap into all my corporate experience. When I was overseeing the sales report and looking at our marketing plans and, 7 agency partners and having $100 million budget, I was then able to step back and say, you know what, this is really a business. See, when you got a 2-unit building, there's not enough money coming through to run it professionally, right? You got 2 tenants, right? Maybe you're making $2,000 or $2,500 in gross rent. You've got your mortgage, you've got your utilities, you've got your insurance. So you might net, let's just say you net $300, $400. That is not enough money to run it like a professional organization. So
there's no scaling potential there.
There's no scaling. There's no scaling. Yeah. There's no offloading stuff. You don't have somebody on standby for certain things, right? So there are things that you have to do yourself, right? If you work with a property manager, which many people tell you to do, well, now you got to trust this property manager is doing everything. But quite frankly, they're leftover profit potential from you, which is why most people don't do that. The difference, though, is on my commercial real estate projects, we have tens of thousands, if not hundreds of thousands of dollars flowing through every month. So I now have the ability to hire professional people. On my properties, I have dedicated property managers who only get paid through us. They're not running around trying to manage 20 units, right, or 20 different properties. They're at my property all day. Most days, right? So they're at our property. That's where they get paid. So they're looking at the nuances. They're picking up on the things that an offsite manager wouldn't see because they're not there enough. They know the resident base. They know the challenges that they come across all the time. So we are able to run that like a professional business. We can bring on professional third-party contractors. I can get the plumbers that are licensed and bonded. When you have a 2-unit building, that bonded a plumber, that bonded electrician, that bonded contractor, they're going to charge you a lot more than maybe what you have in your budget. But when you're going professional, you have to use those professional companies, right? You want people who have not just the insurance and the bond. And the reason a bond is important, by the way, if you don't know, is just because someone has insurance doesn't mean much because insurance companies can drop them. When they have a bond, it's pretty much guaranteed for you. If something were to go wrong, if they mess up your property or something just goes wrong, they have something that you can, basically almost put a lien against them for that bond, and it's going to hold them accountable. So that tier of contractors or vendors is a much higher pedigree than the typical handyman guy that you may get for your 2 a.m. leak. So it's important to just run it like a professional organization. And that's one of the things that's harder for a newer investor to understand because in their mind, they're equating it to running a 2-unit building. And it really is different because it's not you trying to run around and put out the fires that you see on a 2-unit building. It's really running a professional organization when you talk about commercial real estate.
So I'm curious, oftentimes folks who sort of move into this sort of larger class, this, let's call it sort of the middle market of commercial real estate. Oftentimes folks find out that they have a certain buy box, that their sort of business plan or their niche is something that they can execute over and over again. And like you say, sort of develop an area of specialty in so that you've gone through it a few times so that when the potential LP looks at the team and tries to see, do they have a track record of executing on this type of deal? Most developers or sponsors will sort of have their niche, their area that they've carved out, whether that's a geographic or asset class or business plan niche. I'm wondering, what are the types of projects that you particularly like to get into that you feel like you've been able to sort of carve out in this sort of phase of investing, post direct investing, where now you're sort of building bigger projects or you're working on bigger projects?
We primarily focus on B-class multifamily value-add deals. So what that means is properties built in.
Break all those words down because I think those are they fly fast.
Absolutely. So when I say B-class, what we're talking about is kind of the vintage, the type of property. So that's going to be a 1980s, 1990s, maybe early 2000s property. But this is not luxury. It's not the high-end, brand new stuff with all the bells and whistles. But it's also not, the rough stuff where, you kind of try to drive by real fast and maybe skip through a couple stoplights and stop signs. It's not that, right? This is desirable locations, but more affordable as far as the finishes in the property. So one of the ways we like to look at that is by the income and the crime rates, and making sure that, again, the crime rates are low, the income is high enough where people can afford what we want to do to the properties. And that's a great indicator for us. Again, we're avoiding the luxury, we're avoiding the rough areas. We want to be in working class neighborhoods and working in the environments that are attractive for that resident base. So B class, okay? When I say value add, Midwest you get, so Midwest multifamily you get. When I say value add, what I'm saying is we want properties that are already making money. We're not looking at brand new ground up development necessarily. We're not looking at what we call distressed deals. A distressed deal would be one where the property is losing money. Maybe occupancy is, 60%, 70% or less, and it's not making money. There's a lot of work that needs to be done to turn this project around. We're not looking for those. There's a lot of money that can be made in those projects. They're going to have higher return projections than what we're doing on our projects, but they also have a higher risk profile, meaning it's more likely that those deals could not pan out. You could lose all of your investment, particularly if things go wrong that are maybe out of your control. So I want something where it's already making money, and we're going to bring our business plan and identify ways to help it make more money. That's typically going to be through updating some of the finishes, so the kitchen, the bathroom, the light fixtures, the floors. We're looking at those things, right? The exterior, maybe adding some amenities to the property. We're looking at a way to do that so that we can increase the rents, create a better community environment where people are willing and wanting to pay more to live in that environment. And we are finding ways to drive value through those means. So we look at value add deals in Midwest markets, primarily like Cincinnati, Columbus, Louisville, Kentucky. We'd like Indianapolis as well. But we will do some stuff in the Southeast region on top of that. But that's pretty much our buy box. We like those deals. I would say maybe 75 units to 200 units. We're open to going a little bit bigger, but that's kind of been our sweet spot up to this point.
Interesting. And so, if that's, let's say, the business plan, right, that you're looking for these Class B, that you're going to do some value add, again, that's like a sort of a light remodel. You're not going to go gut the building. You're going to change out some of the fixtures, maybe take out the carpets, put in some tongue and groove floor. So, you sort of you spruce the place up a little bit, right? In the hopes that you'll be able to raise rent to match what I'm guessing is you anticipating some sort of, upwardly mobile middle class families that are, okay, we don't want the place with the old rugs from the 90s. We're looking for a place that feels a little bit cleaner, feels a little bit nicer, right? That's the business model. Is that right?
That's spot on, right? And when you think of it, some people might use the term workforce housing. I think sometimes the terms get a little confusing to people. But think about your police officers, your firefighters, your teachers, your nurses. Think about the homes where they would want to live, and where the economy is today with interest rates being high. Some folks maybe don't have the funds for a down payment, or they can't afford a house right now at this point, or maybe it's just transitional, right? They're going through things in life, so they're looking for an apartment, but they're looking for a decent apartment, right? A nice apartment. Again, not necessarily Class A luxury, but everyone wants a nice place to live. Even if it's an apartment, you want to have a nice place where you're comfortable bringing people over. It's clean, it's modernized. It looks like it was, touched in the last 20 years. So we like that, shaker cabinets, white countertop or white cabinets, nicer countertops, either granite or nice finish on the countertops, the LVT flooring, newer light fixtures, maybe a light gray kind of color scheme. But you want something that looks fresh and nice and inviting. So those are the kind of things we're looking to do with those apartments.
Yeah. You don't need a rooftop pool, but maybe a gym that's shared by everyone is a nice amenity to have. I wonder if, we've got the sort of business plan there. What do you look at in the communities that you're targeting for these type? What are the sort of, you said we've got team, market, and deal are sort of the three, things that we need to ask questions about. As far as the market is concerned, what are the factors that you're looking for that you feel like this is the thing that's going to drive our ability to invest in value add, knowing that we'll be able to mark to market, as we say, raise those rents to a place that you feel like will generate a bit of additional revenue for the building?
Yeah, it's important to look at both the macro and the micro when it comes to the market, right? So, in the macro level, I'll just use Columbus as an example. So, Columbus as a market has seen great growth over the last 10 years, really over the last 50 years, but over the last 10 years, it continues to grow. It's the center of Ohio, capital of Ohio, a lot of infrastructure there, with it being the capital, Ohio State University, a lot of big companies that are located there that are driving some of that growth. So we want to see that, right? We want to see people moving to an area. We want to see rents climbing and overall just strong demand for that location. On top of that, now we're going to go into the micro market side, because every major city has desirable parts and undesirable parts. And the key is you want to find the areas that are seeing growth and they're becoming more and more desirable. It could be because maybe there's infrastructure development. So in a lot of places, you'll see there, and I'll use Cincinnati for this one, but there's a bike trail that's being added. Or recently they developed the soccer stadium for our MLS soccer team, and they did that on the west end of Cincinnati. Well, guess what? The moment they announced they were doing this, all of those properties shot up in value, and people, couldn't wait to move over there and get close to the action. I was in Chicago when Obama was president, and shortly after they announced that the President Obama Library was going to be going into a neighborhood on the South Side. Well, guess what? The moment they made that announcement, all the property values shot up, right? And people couldn't wait. I was also there when they were vying to get the Summer Olympics, and everyone bought all the properties down the South Loop, expecting to get the Summer Olympics and expecting their property values to go up, and they didn't get it, right? So those kind of developments can have huge implications when it comes to real estate. Those are obviously major developments, but I would also primarily focus more on infrastructure. Again, where are the freeways? Are they adding exits? Are they adding train stops? Here in Cincinnati, the Amazon built a $1.5 billion airport cargo hub, and that had huge ramifications for the surrounding area. So I'm looking to see in the micro level, where is the investment flowing? Why are they looking to invest in this area? I want someone else to do all that heavy lifting. So that's a big part of it, is really just understanding what's happening there. When it comes to the actual community, I just want to get a feel for it. Who lives in this community now? Why do they live here? Do we want to keep that current resident base? Do we feel there's an opportunity to reposition the community, maybe to upgrade the community? I'm not big on trying to replace a community. I know some folks have no problem, going to an area and maybe gentrifying it. That's not really what I like to do. I really want to take what's already there and just enhance it, and that comes through looking at other factors. But we really want to take properties and enhance what's there so that we can give a better community or an enhanced community. Because keep in mind, a lot of times, no one has really developed or touched these areas or these specific apartments in years, 10, 20, 30 years. And imagine what was in style 30 years ago when it was developed, right? So the opportunity to bring that, to life and inject some capital infusion to modernize that is really desired by a lot of people. So that's really the way we focus on it.
I love that. And like you say, these stories are such an important part of real estate in general. And I think it's one of the things that attracts investors to real estate over time, is that they feel like there is not only a tangible asset, but a tangible story. It's, we can imagine ourselves into the lives of people who are going, hey, whatever, the light rail just expanded to this part of town. And that means that now I can maybe move into a different neighborhood, but still get into my job or whatever. You're a former marketing person. I'm a marketing person. We professionally have learned to tell good stories. And I think the thing that sometimes investors want to know is not only that it's a good story, but that they can, verify some of this narrative, because there are lots of good storytellers in the world. And again, I love the story part of it. But I'm wondering, as you're telling investors to look at these 7 questions and to, sort of focus in on the team, on the market, on the business plan, it's easy to say sort of broadly, like, well, double check this stuff. But are there like specific resources that you feel like people can go to? Are there ways that folks can sort of do this version of due diligence where they can start to back up some of the facts that the stories are based on?
That's a really good question. It's an intricate question as well, right? Because there's so many different components of the story that, can be verified and all those kind of things. I think the biggest thing is just what is the story at a high level? Okay. And does it make sense? And I do this when I'm looking at a deal, even as a buyer, because what happens a lot of time is you can waste a lot of time looking at deals that are not going to pencil out. And I'll give you a good example here. When I'm talking to a broker about an opportunity, I ask them that question. I say, hey, what's the story? What's going on in this property? What's the deal? And they may tell me something. Once I have that story, now I have the lens to look at the numbers. Because without the story, these numbers, the T12, the rent roll, maybe something jumps out, maybe it doesn't, right? But sometimes a lot of times, especially with the deals we're looking at, things don't necessarily jump out right away. But once I have the story, now I know what I'm looking for. Are rents increasing or rents decreasing? Is occupancy increasing? Is occupancy decreasing? Like if they tell me, to give you an example, if they tell me, hey, this owner's had it 30 years. He had a property manager that just passed away 6 months ago. It's becoming hard for him to manage it now himself. So he wants to sell. If that's the narrative that I've been given, I should see some of that play out in the numbers. I should see maybe the rent roll where there's concessions or occupancy is declining, or there should be some hurt or some impact that's reflected in the numbers there. It might be the opposite. It might be a syndication group where they bought this property. They did everything I just told you we would do. That's what they've been doing. And now they're trying to sell and exit. Well, I should see the increase. I should see the rent roll going up. I should see the income going up. I should see how they've been able to add value. And then I can figure out what I'm able to do moving forward. But the story helps me understand the numbers. Otherwise, you're just looking and you're guessing. And again, there's that trepidation because you don't know where the bodies are. People tend to hide little bits of information, and that's okay. It's part of the process, part of the game. But when you have the right lens, you know what to look for, you know where to go. So a couple things that I'm always paying attention to. First and foremost, I'm looking at the occupancy, and I want to see just kind of what that looks like from a trailing 12 standpoint. What historically have they been able to do as far as the income, and what story am I seeing? I'm looking at expenses. I'm seeing just at a high level, are there any expenses that seem out of whack? When I look at a T12, which is a trailing 12 months of the current business performance, I'm looking to see what jumps out to me. And this goes back to the statement I made before. When you're buying a 2-unit building, you're buying a rental house, you're not looking at these numbers, right? You're looking, oh, what's the rent? Oh, the rent's $1,200. Oh, okay, cool. How much is the taxes and how much is this? And you guess from there, right? You figure out your numbers and you guess. When you're buying commercial real estate, I'm looking at the last 12 months, if not the last 2 or 3 years. I'm looking at the financial history of a business that I'm buying. And I'm looking at that business's financial performance, and I'm identifying and I'm confirming my business plan. Because I can go in and think that, hey, we're going to push rents $300. But I might look at it and see, oh, they tried that and they spent a lot of money on marketing and they did not get the $300. Oh, there's a flaw in my business plan. What am I missing, right? So now I have a chance to step back and pivot and analyze, okay, am I missing something? Do I need to try a different business plan, or is this still just not work? So you got to go through that whole process, and the numbers tell the story. The truth is, you really want to partner with someone who understands that, because if you're a newer investor, it's unlikely that you're going to be able to look at those numbers and understand the story better than a more seasoned investor, which is why it's so important to find somebody who has the integrity, kind of the trust, the track record that you feel comfortable investing with. And I would just ask them the questions, right? Because these will come up. If I tell you a story of a deal, when you go look at the numbers, you'll see it verified. You'll see kind of the implication that, oh, okay, that makes sense. I see what he means. If I tell you we can push rents $300, I should be able to show you a comp that is getting more in rent that we can mimic and we can model ourselves after to get that additional $300 in rent, right? So now it becomes a little clearer and easier to understand what kind of questions to ask to verify the business plan. And one great question to ask, and this is in that 7 questions, but one great question to ask is, what can go wrong? Because as investors, we're always optimistic, especially real estate investors. We're optimistic. But the truth of the matter is, there's always risk. There's always some level of risk in every single deal. if you can identify what those risks and those threats are, and then figure out what the plan is to mitigate those risks, that's going to allow you to sleep better at night. Or it may be something that you realize is too great of a risk for you to try, and you may decide this deal is not right for you. But to understand that makes you a much better investor. And I think it's something every investor should be asking before they invest in apartments.
Incredible advice. That's great. John Casmon, thank you so much for taking the time to be on the show. I really appreciate it.
Absolutely, man. It's a pleasure.
I'm sure there are a lot of different ways that our listeners can find your information and your insights. I know, you're the founder of Casmon Capital Group. You host the Multifamily Insights podcast. So if you like what you're hearing from John, you can listen to him all the time through his own podcast. We'll put links to all that in the show notes. John, thanks again so much.
Thank you again for having me. Appreciate it. Great time here today.
All right, so that wraps up today's discussion on multiple perspectives with John Casmon. It's interesting, Daniel. I feel like the framework that he shared, the 7 questions, the sort of 3 pillars of asking about the team, the market, and the deal is a really smart way to sort of approach digging into an offering.
Yeah, it's funny. Whenever I'm doing a sponsor Q&A, I'm meeting with the sponsor, asking them questions on behalf of investors. We've sort of followed that same format. Like, who are you? Why are you good at your job? What have you done in the past? What's the shtick or the spiel with your company? Okay, let's get into why did you pick this market? And then we unpack, like, the market's a good place. And then we talk about the deal. And with the deal, it goes along both the real estate, the quality, the vintage, the value that you're getting it at, but also the plan that you have to go into. Like, okay, what are we matching with that real estate to add value? Or why does the business plan make sense? Why is it a no-brainer for someone? And how do all these 3 pillars combine? Oh, and by the way, that's the same way that I think that our real estate team unpacks deals as well when we're trying to assess a deal in our investment committee.
Right. Yeah. And so, it's interesting. You do these sponsor Q&As for a lot of our deals. Those are always available on the deal page, on the offering page on the website. For listeners who are curious about learning more about John's specific 7-question framework, you can find that at casmoncapital.com/7-questions. We'll also, of course, have a link for that in the show notes. You'll be able to find more information from John, including, the way that he sort of emphasizes that the story has to match the numbers. I think that's something that we're constantly looking at as well, that there are a lot of people who are good at telling stories. And there are a lot of people who are good at, just sort of doing the math. But it's really important to make sure that those 2 facets of an offering line up.
Yeah, story and the numbers, qualitative, matching up. Well, David, thanks for sharing that episode with us and that conversation. If you like this episode or like our content on multiple perspectives, feel free to subscribe, rate us, share with friends. It's the best way to give back is to pay it forward with your friends. So we'll see you next time on Multiple Perspectives, and thanks for tuning in.